Hello, everyone. Good morning. Uh, so again, glad to see we have a good number of attendees for today's session. Much appreciate those who have attended prior to the session time. That shows how serious and interested they are pertaining to today's webinar. And appreciate those who have joined and with us today. So without any delay, we would like to start the session. Just to introduce Professor Renuka Sane is with us. She's the guest speaker. And a brief about her profile and background. So Professor Renuka Sane is an associate professor at the National Institute of Public Finance and Policy. Her research interests lie in household finance, especially on household choice in financial instruments such as credit, pensions, insurance and equity markets, as well as consumer protection in finance. And today's topic, as you all know, who protects the consumer, the case of Indian finance. Looks very interesting, and hopefully, we are hoping that you will enjoy this session. And this will be as engaging as like any other session webinars that we have done so far. Just a quick, information before I hand over the session to the speaker. During the Q&A, the questions will be answered. You can keep posting your questions as and when you feel like, during the session. If any question pops up in your mind, you can drop it in the chat box. That will be answered by the speaker during the Q&A session. If any question went, unanswered due to the paucity of time, it will be replied or responded over an email post the session. Okay, so without any delay, again, I'm just handing over the session to the speaker. Professor Renuka Sane, over to you.
Thank you for that introduction, and thank you for having me here. And good morning, everybody, and thank you all for attending and showing interest in this particular topic. What I would like to do is to share the presentation with everybody so that you can all see the slides as I go through them, and then we can, discuss the topic at length in the Q&A session. But before I begin with the slides, I think I just want to introduce by saying that this is a topic that covers us all. All of us want to save. All of us are worried about our old age. All of us are worried about financing our lives. And increasingly, I presume that I could guess that most of you have had trouble with advisors, distributors, bank managers coming and trying to sell you stuff that sometimes you don't want, and that sometimes you have not understood but find yourself with. And this is not a unique problem to India alone. This is a problem that I think the world over countries are facing, and unfortunately, nobody has quite figured how to deal with it yet. So, in this talk, I want to first start by talking about the problem in India and laying out what evidence we have on the kinds of issues that are arising in this space. And secondly, we will talk about, where is this problem coming from conceptually. If we understand this better, then we might be able to think about policy solutions as to how to solve this. And finally, I'll lay out the challenges as to why it is that it's still not solved and why is it that we're still grappling with the issues. And I hope that you find this informative and interesting. And, as said in the introduction, please feel free to send in your questions and we can take them up in the Q&A session. So can we load the PPT? Yes, please. Okay, so yeah, yes. Let me begin by this particular visual, and it's kind of pertinent to all our lives. It's kind of what we get puzzled by or struck by when we deal with financial service providers. And so, what is the evidence that we have seen in India of consumer financial protection, or things going wrong? So, let me start with early 2000s. So, this was a period between 2004 and 2006, where in the mutual fund space, there were closed end funds. Closed end funds are where you can't get in and get out whenever you want, as opposed to open ended funds where you can exit whenever you want. And there was a slight difference in regulation in the sense that closed-end funds had to declare what was their entry load, which is the money that you pay to get into or buy units of the fund, whereas closed-end funds could charge these initial issue expenses and not charge entry load. So what happens is that investors can see entry load. So when you're buying something and you're paying 100 rupees for it, you see that you're paying 100 rupees for it. Whereas investors cannot see change in value because of initial issue expenses. And so in that brief period, when there was this differential regulation between these two classes of funds, you see that multiple closed-end funds were launched, and there was a high churning between customers who were pushed into these closed-end funds because they probably didn't understand what is it that they were getting into, and funds of course wanted to sell these products where they were able to charge a higher fee. And so this is a paper that got published in the American Economic Review, where they study this particular episode, and they report that the customers actually lost to the tune of about 350 million US dollars because of this bad behavior or mis-selling by the mutual funds. Let me come to another examples. Many of you must have heard of ULIPs. These are unit-linked insurance plans that are quite similar to those of mutual funds, except that they have a layer of insurance over them. So in the period again between 2000 and 2005, 2005 and 2010, the ULIPs were very heavily marketed. People were told that your money is going to double or triple in 3 years. Nobody was told that there were certain costs hidden in these funds, or that there was a 3-year lock-in, which is that if you left before 3 years, then you pretty much lost a large part of your money. And this kind of messaging was never communicated to consumers. And again, in a paper that I co-wrote with Monica Hallan and Susan Thomas, we find that a lot of policies were missold during this period, and we measure this in terms of how many policies got lapsed, which is that they didn't get renewed. And we find that over this time period there has been a 1 trillion rupee loss to customers. So here's an example of what happens when there is a uproar about the laws, and then the regulator is kind of forced to act. So regulator said, okay, I'm going to clean up the ULIP products, and I'm going to put all the costs under one head, and cap a surrender charge of 6,000. And so what did the industry do? So now ULIPs were not particularly remunerative to sell, and the industry just moved to selling traditional endowment plans, which are even more costlier and have even more opaque products. So if you look at this graph, you see that as soon as the regulations came into being, very soon you see a complete switch in what it is that the industry has started selling. And even today, what sells in terms of insurance are these endowment plans, which are essentially plans that give you a very, very tiny insurance cover and also give you a very, very tiny IRR. So if you look at the IRR on an endowment product, it's roughly in the range of 1 to 4%. And even fixed deposits and PPF actually get you a better IRR today. But these are the policies that get sold. And here's an example of the persistency of life insurance in India. So when these kinds of policies are sold, people don't particularly know what they've bought, but when they realize they don't want to be a part of this policy anymore, and they drop out and they lapse. And a measure of how well insurance functions is persistency, which is, if I buy a 15-year policy, for how long do I continue to pay that policy? And if you find that if you see this study, you see that India has probably one of the worst persistency metric when it comes to insurance. And finally, there was an audit study that once again Monica Hallan and I did, where what we wanted to know was how is it that these sales happen and what is the motivating factor behind these sales. So in this study, we sort of audited 400 bank branches in Delhi. So this was a mystery shopping exercise where our surveyors or our auditors posed as customers and walked into a bank and said, I want to do I want a tax saving product. Some of them said, can you please give me equity linked savings scheme, which is a mutual fund product, which also gives the same tax benefits. And some of them said, I just want a tax product. What do you think you will suggest? And we find that most of the private sector bank managers suggested a high fee paying to them insurance product. regardless of what was asked. So I can go and ask for product X versus product Y, but what the bank manager will do is always sell me the product Y, which is most remunerative to him or her. And that's not surprising. Whereas in public sector banks, managers only recommended fixed deposits. Worse still, all of regulators have rules around disclosures that when you buy a product, XYZ features have to be disclosed. But what we found was that the more complex a product attribute, the less it is disclosed. So costs and lock-in are rarely disclosed voluntarily. If you persist and ask managers questions about these particular product features, you find that the answers are either incorrect or incomplete. So, for example, on costs, managers will only tell you that, you know what, there is a front end cost of this much, but they won't tell you that every year you also pay this much. Um, and regulators, what this told us was that while regulations may require disclosures, what happens on the ground is very different from what might be there in the regulations or the law. And of course, in that paper, we argue that the highest priority in banking policy should be to achieve regulatory capacity. So, if you just look at these studies, if you look at newspapers, if you look at your own personal experience, I think that I would summarize the problem of consumer protection in the following way. One is that sales of financial products are driven by commissions. Today, if you go to any distributor, the distributor will sell you the product that makes most sense to him and not to you. And most likely these sales are detrimental to consumer interest because they are not servicing you, they are servicing themselves, because they are paid by the product manufacturer and not directly paid by you. So their duty is not to you and their duty is to the product manufacturer. The other problem is that consumers are unable to differentiate between products. So if I were to give you product A and product B, if I were to give you phones and one phone was clearly inferior to the other, then no matter how hard the distributors try to sell you the inferior phone, you would be alert to the fact of what was being sold and you would choose the phone that best suited your needs. But unfortunately, in finance, this is not happening and consumers are unable to differentiate between products. And that makes it easier for distributors to kind of sell whatever it is that they want. And consumers often don't even know what they have bought. So if I were to do a survey amongst you, and if you had bought insurance, and I started asking you questions on what kind of insurance have you bought, most likely you would not know the exact answer. Or maybe this is an elite crowd. But when we have done surveys on the field and we've asked people if they've bought insurance and they've said yes, and we've said, so what kind of insurance have you bought? And they pretty much don't know. They say, wo paisa deti hai, or some such thing. So consumers most often don't know what they've bought, and by the time they realize, it's too late. Or if they realize in a couple of years, then they just lapse the policy. And I think that, given this, we need to ask ourselves, why is it that we are in this place, right? Why is it that uh, the normal market forces, if you will, just do not work? Uh, so, from the academic literature again, we find that what's essentially happening is that firms choose to hide information from customers. And of course, if all of us were rational, firms should unshroud the prices and sellers should have incentive to offer terms that deliver the best value to you, because that's when you would come to them and the problem would be solved. But unfortunately, we've not seen that in the case of retail finance, and shrouding still persists. And so the question is, why is it that shrouding still persists? And so this is from a very interesting paper by Gebe and Lipson in 2006, where they say that in a market where there are two kinds of customers, as sophisticated customers and there are myopic customers, and more customers are myopic than sophisticated, then if a competitive firm points out the shrouding, sophisticated consumers will stay with it and not buy the add-ons, but myopic customers don't know better. And competitive firms gain nothing because myopic customers are the ones larger in number, and so they don't make money out of the shrouding, and they don't make money out of the unshrouding either. And this is what the authors call the curse of debiasing, and which is why there is no incentive for firms to actually unshroud. And again, so harping on the same point, there is a lot of information asymmetry in these markets. If you wanted to have a fair deal, or a deal where buyers can actually make choices such that sellers can sell them the right thing, buyers and sellers need to have the same information, and each lender may have some degree of market power if the consumer cannot really compare prices in terms. And mind you, this is not always in the it doesn't always work badly for the consumers. In some cases it works badly for the sellers, for example in the credit markets, where the information asymmetry is actually upside down, which is that the creditor does not know whether the buyer is a or the debtor is a good debtor or not. So uh, essentially, the problem is this, that a high road seller who offers what she knows to be the best product will lose business to the low road seller who offers what the consumer mistakenly believes to be the best product. And I think that seems to be the central problem in this particular space, that there is absolutely no incentive for any firm to actually do better. The other reason why this doesn't work, and is bounded rationality. We hear of bounded rationality in many aspects today, and which is that consumers have behavioral bugs. Consumers are not able to understand actually what is on offer. There are problems of irrationality, and in this slide I have kind of shown some kinds of biases that have been very well documented in the literature, such as overconfidence. People are just overconfident in their judgments. No matter what you say to them, people think that they know it. People are very optimistic. Then people cling on to their opinions too tightly for too long. There is anchoring, which is that if I showed you some initial value, you kind of get anchored to it, and then it becomes very difficult to make you move away from it. There is a problem of availability bias, where more recent memories are more salient, and so they will be weighed more heavily and distort the estimate. Then there is, of course, loss aversion. To give you an example of bounded rationality, in our field studies, we find that when an insurance product is being sold, people somehow want something back at the end of the 15-year term. And then it doesn't matter that what you're getting back is a lousy deal, what you're getting is a really bad insurance cover. But just, there is this bias that you want something back. And if companies are able to play on that bias, then they are able to give you really bad endowment products, which neither provide you with a good cover and nor give you returns. But people will still cling on to them, because in a term insurance product, which is where you only get insurance, but you get a very high cover and nothing back at the end of the policy term, people seem to be uncomfortable with the idea that they get nothing back. So this is a mixture of financial illiteracy and bounded rationality, where firms are able to play on this particular bias and do what is best for them. And so this kind of limits how much explaining a high road seller can do before losing the attention of customers. So, and this is again a problem, that even if as a seller I wanted to sit and explain to you the intricacies of a product, most customers are not interested. Most customers would say, just tell me where to sign, tell me what's good for me, and move on. In that case, it becomes extremely difficult for sellers to take the effort. And again, like I said in the beginning, they get nothing out of it. Now, you might argue that problems of illiteracy, problems of bounded rationality are there in every field. I mean, they are there in every decision that we make in our lives. So what's the big deal? And I think that the big deal is this question of time and learning. In most aspects of our life, we our views are not fixed, they evolve. We make mistakes and we learn, and making those mistakes is very important, because that's how we learn to do better. And so if we make repeat purchases, then the seller has an ability and incentive to build a certain kind of a reputation. Also, if I make repeat purchases and I make mistakes, then at every purchase I'm learning what I need, what is bad about this product, and how do I do better. And calibration of these things is easy when outcomes are predictable and feedback is quick and precise. So I buy something, I need to know whether it was a good decision or not. So the next time I buy, I can use that learning and make another decision. And that's how people learn. However, when it comes to financial products, this kind of purchasing is relatively infrequent. And so what happens is that that feedback mechanism is broken. So competition, will not always induce sellers to correct these consumer mistakes, because once you've bought an insurance policy for 15 years, you're not going to buy another, unless you realize that this was a bad policy or something happens. And so since you're not repeating these decisions again and again, your ability to learn from your mistakes is extremely limited. Okay. And ability to even figure out that you've made a mistake is extremely limited, because you've bought it and the actual event may unfold many months or many years later, by which time it is too late. And I think that's part of the reason why this concept of learning does not work very well in finance. And like I said earlier, that the way the distribution channel is structured is also a problem. So the person selling the product to you is not aligned to your interest. The agent facing the customer is typically employed by the manufacturer, and the incentive of the agent is to service the manufacturer and not the customer. So when I, as an agent, face these high-powered sales incentives, there is a pressure on the sales end. I need to meet my targets, and there's absolutely no obligation on the customer satisfaction end. Neither can the customer ask me tough questions. Neither can he figure out what the hell is he buying. He is inattentive, and I lose nothing if I make a bad sale. Then you can see how the incentives for the distributor are misaligned. So the distributor is obviously going to do what's best for himself, and that is to make his high commissions, because there's absolutely nothing to stop the distributor from the consumer end. And I think that that's part of what is going wrong in the distribution channel, which is that we aren't really paying for advice, and advisory market does not exist. To give you an analogy, this is like a doctor patient model, and of course many things go wrong in the doctor patient model, but it's almost as if the pharmaceutical company is paying the doctor to service me, and the doctor's interests are with the pharma company and not with me. And I have no ability to judge the doctor or ask him or her questions, and he's not servicing me because I'm not directly paying the doctor. Of course, at the end of the day, all the money the customer is eventually paying, but I don't know that, I don't see that. And therefore the doctor has no interest to serve me, which is the same that the distributor has no interest to do the right thing by me. So if we look at these class of problems, if I had to summarize what was the problem, I would say that there is this asymmetric information between firms and consumers. The payoff is postponed. There's also too much choice, leading to confusion, in the sense customers are financially illiterate, they can be irrational, they don't know how to make up their minds. And there is the incentive for selling is such that the commissions are paid by the product provider and not by the customer. And if I may add one more point here, from a consumer protection end, there is absolutely nothing that penalizes the distributor for bad behavior, either through the customer who says, I'm not going to come and buy from you again, or from a regulator who kind of penalizes you for doing the wrong thing. So that seems to be the pervasive problem in retail finance. And it's not entirely clear what the solution is. So here I just want to play out a few potential regulatory solutions to the problem, right? So since we said that incentives matter and that commissions are a big problem, maybe you could frontally attack the commissions problem, and you say you ban all kinds of commissions and customers only pay fees to advisors, and then you would have to worry about quality of advice, handling of bad advice, etc., etc. So but that's one direction that regulation can go, if we think that the problem is only with the distribution structure or the compensation structure. The second is that you say, all right, I don't want to say anything about compensation. Let it be completely handled by the industry. I don't want to put these price caps because, hey, as regulator, what do I know about what the right compensation is? Um, but what I will do is that I will mandate improved disclosure, and I would increase penalties on missales. And Of course, since we live in a nudge world, one could be that regulations nudge distribution towards a certain direction. besides the fact that as a regulator, I don't know what the right commission is, there is another problem with banning all commissions. At the end of the day, if we want financialization of the economy, then we need people to go out and sell these products. And commissions may be useful in incentivizing agents to seek new customers. So we should not be completely, have a negative view on commissions. They are also useful, and considering that we have very low financial inclusion in this country, banning all kinds of commissions may not lead to the desired outcome. If you leave compensation up to the industry entirely, again, there can be problems. Incentive structure, like I mentioned earlier, is an industry wide problem. So it's difficult for one player to change the system. And because the market is structured as it is structured, it's difficult for one high road seller to say, you know what, I'm going to do the right thing, because eh, the base is not there to reward him to do the right thing. And if you think about disclosures, again, the evidence on the disclosure front is kind of disheartening. uh, Basically, mandating disclosures is not enough. Disclosures have to be an eye opener. Sometimes disclosures have unintended consequences, which is that advisors seem to be just more comfortable giving biased advice because, hey, I've given you this piece of paper with whatever disclosures there are, so now I'm off the hook. And again, there is some field work that we did, and we found that disclosures only make sense when consumers know enough about the concept. So if I give you a disclosure that this product gives you a 2% return, then you will be alert to the disclosure and you will pay attention to it. But if I say something like the cost of a term policy is rupees 1,000, you may not know what a term policy is, and you may not know that a comparison needs to be made. And if you've never heard of these terms before, if you've never understood these terms before, then these disclosures are kind of meaningless. They don't have the desired effect, and I think that that's where disclosures also break down. And again, finally, on the question of liabilities, they have to be enough to make, for us to separate out what I'm calling the high road firms from the low road firms. And the design of such liabilities is not a trivial issue. So it's unclear how to design the liabilities to set the incentives right. And they have to depend on the value of the penalty and the probability of getting caught. And I don't think that we do a very good job in India on these liability structures today. So it's not an easy problem to solve. But this is perhaps one direction to go to, which is that you mandate disclosures, but at the same time, you have some kind of liabilities um, that prohibit or that penalize bad behavior. um, and again, on the compensation structure, that perhaps one starting point is that you say certain kind of compensation structures are inherently unreasonable, but then you will have to answer questions like what kinds of commissions, what conditions before commissions can be received. And again, these are not easy answers, and one has to think carefully and weigh the costs and benefits of one's decision. So if you just did disclosures and penalties by themselves, it's hard. It's unlikely that they will lead to improved decisional choice. So I think my sense would be that you need a mix of all of these things. And perhaps over the long term, what we really need to do is to alter the relation between agents and customers. So if you treat all agents as advisors with fiduciary duties and shift to an advice for fee market, perhaps we'll get better. But again, I'd like to caution everyone and say, look, the market for doctors is a advisory market, but at the same time, whatever we know about the health industry does not bode well. So this is a difficult problem to solve, and that brings me to the consumer protection framework that was put out by the Financial Sector Legislative Reform Commission. This was a commission that was set up under the chairmanship of Justice Shri Krishna, and they, put in their report. They submitted their report in 2013. And what was unique and interesting about the FSLRC was that it was one of the first reports to put consumer protection centrally as a goal of regulation. And the draft law the draft Indian Financial Code said that in this framework, certain basic protections will be available to all consumers, and regulations will be written based on these protections, which is that financial service providers must act with professional diligence. There is protection against unfair contract terms. There is protection against unfair conduct, protection of personal information, requirement of fair disclosure, and redress of complaints by the financial service provider. And there were some additional protections for retail consumers, like suitable advice, protection from conflict of interest, or access to the financial redress agency for redress of grievances. Now, unfortunately, this kind of reform has gotten stuck. We have not moved forward on any of these. All of the regulators pay lip service to the question of consumer protection, but if you see their legal frameworks, they don't really help you with any of these protections that FSLRC said should be given to consumers. Somewhere in 2014-15, I think there was a move to creating a financial redress agency, which would be like a one-stop shop for consumers to complain, and where the grievance redress system would get better. I think again that has not moved forward because current regulators perhaps are not interested in setting up this FRA, and that push from the Ministry of Finance and from customers is not coming. So I think a lot of reform gets done when people ask for it, and for whatever reason, redress does not seem to be top of the mind for various for the government of the day or for the policymakers today. So I think that the way forward would be to reopen the FRA discussions that had already happened. A task force had submitted a report to set up this redress agency, and we need to move in that direction. And finally, I want to end by saying that this is easier said than done. Regulators can put out all manner of laws, but ultimately, if firms are non-cooperative, whose interest is to find ways to work around those regulations, then we are not going to get far. And three conditions, have to work for us to get consumer financial protection. One is that the defaults must be sufficiently attractive to customers. What I mean by that is that there are certain products which, if you can't make up your mind, you know what to choose. It should be sufficiently profitable for high road firms to succeed in offering them. So low cost products, good products, clean products, unshrouded products. There must be some way to reap benefits from doing this. And deviations from the right thing must be sufficiently costly so that the low road firms are also hesitant in conduct of bad behavior. So I think with this, I end the talk, and I'm happy to answer any questions. What is being asked? Should I just address?
Yes.
Hi, Yazat. I have a question from you where you say, is this example from USA or both? I'm wondering which example you are talking about. Um, And on the second question, which is how do other countries handle this situation? I think the situation is kind of similar. Several countries, especially after the 2008 financial crisis, went ahead and put in a lot of regulations where they tried to change the incentive structure. So, for example, there was a retail distribution review in the UK. There was a again, I forget the name, but there was a review of distribution practices in Australia, and all of them came out saying that we need to ban commissions. We need to ban the front end entry loads such that the incentive of the distributor is aligned with that of the consumer. So that is the direction pretty much in which the world is also moving, and India is also moving. On the question of whether LIC buying shares in various PSUs and whether it is justified for LIC, I think it's a little off the topic when it comes to retail finance. So I'm, not going to address that frontally. But what I will say is that, until you have this kind of a system, it becomes very difficult to push reform down LIC, because LIC seems to be playing a central role in buying many of these bonds. So I think we also need to understand where the pressure for not reforming distribution comes from. And I would argue that some of it comes from these kinds of structures, such as LIC, buying all manner of bonds that are being sold. In terms of, so here's a question which says that since there is a lack of knowledge and awareness, what are the avenues which could be utilized to educate oneself financially? I mean, look, this is tough. I think one needs to read more and understand the products more. There are books on this subject. You could also, find a good financial advisor, and sometimes I think it's worth our money to pay a good financial advisor to get this kind of advice, to figure out what is the right thing. Another suggestion would be to just go for low cost index funds, where there is no active decision being made, where you're not doing the stock picking, where you're just sort of following an index. So until one becomes financially literate to actually do stock picking, one can just do the default products like a term insurance product if you need insurance, and a low cost index fund for investments. I can't think of any non-regulatory policy alternatives, because uh, what is it that will make firms want to do the right thing? They'll only do the right thing if there is any benefit to them from doing the right thing. And I think that until the industry is cleaned up, until the structure is such that bad firms can do not get away from doing those kinds of things, non-regulatory solutions are unlikely to work. So you need some kind of a regulatory, disincentive, for example, to or penalty, so that you won't do the incorrect thing. The size of the population is small in India. Insurance is larger than mutual funds. I would guess from household surveys that I have seen, about 30% of households claim to have insurance, and less than 1-2% of households claim to have mutual funds. But given the size of India, this becomes a sizable number, and that is also a problem. So, see, one of the reasons why people don't engage in financial markets is because there is very little trust among them, where there is very little understanding of the product, or when there are problems, there is no grievance redress mechanism to go to. And so one of the manifestation of a bad retail market is the fact that nobody wants to participate, and that's also a bad thing. So I think that we also need to see the cost of this in terms of non-participation, because even though we have a very high savings rate, most of our money gets locked up into real estate and gold, and does not go into financial products, which is where the conduit between firms and households, that's the channel through which you can transfer savings to more productive uses by lending to firms. But that's not happening. That's broken. And I think bad retail markets is one reason why it's broken. Yeah, I think financial knowledge among rural India is likely to be very poor.
So, in case, thank you so much, Professor Sane. In case you have any more questions, we can actually take a couple more questions. Yeah, I think we have one more question here. I'm not sure what political engagement means. Okay. So, could you please be more clear on your question? The question is about, yeah, this is from Nishka Raman. Grievance redressal mechanism would encourage political engagement in financial markets. So in the meantime, if anyone has any further questions, then they can post their questions here. If not, you can actually, you know, post a question to us over an email at contact@ispp.org.in. It will definitely be addressed. Yeah. So we'll take one last question. So questions started flowing in, but just a second before. Yeah. How
Yeah, so I'm not entirely clear why FSLRC is not moving ahead, but I'm kind of deducing that it must not be moving ahead because it is, for whatever reason, is not a priority anymore. But I don't know the true reason.
Okay, so we have one last question. This will be the last question. I'll just read out the question for you, Professor. So the liquidity issues with the recent mutual fund managers creates a lack of trust. So how do you think enough confidence can be generated in
So
common
I
public?
think this, goes back to two issues. One is how is it that these debt funds were sold? So if you look at the current problem in the debt mutual fund market, debt mutual funds were, again, this is anecdotal evidence. I don't have proof for this, but when you talk to people in the market, these products were sold as these products that are very safe and, just like fixed deposits. But one knows that debt markets are not that safe. So I think there was a problem at the sales end. And secondly, there was a problem that when things started going bad, mutual fund managers should have acted and you should have written down those investments and taken a hit on the NAV. That sends out a signal to people saying, hey, this is not as safe and people can get out. I think on both these fronts, we have been a kind of a failure, and I would expect has dented confidence in the common public, because now once again they don't trust whatever is being told to them. So I wish that we had been more open and more vigilant when the sale of debt mutual funds was happening, and when liquidity issues started to hit, we had reacted in a more in a faster manner. But let's see how this evolves.
Well, then, thank you so much, Professor. I mean, very elaborative responses and answers. And that's what actually participants were expecting. In fact, that's what they were writing. As soon as we announced about the webinar, we have seen a couple of comments on the posting saying that we are really looking forward to this. And we also received one comment over here that this was very informative and insightful. Thank you so much for your time. A pleasure to have you. And so before we leave, and just a small announcement, this webinar recording, as like any other webinar, all other rest of the webinars will be uploaded on the YouTube channel, the entire recording. Whoever has missed it, it will be sent to them as an email. Whoever is here, so actually to kind of recap the whole thing, you can look into the YouTube channel and then view the recording. And one more thing, so any questions you have, as I mentioned earlier, you can write to us at contact@ispp.org.in. That's the email ID. We will respond to you. And any questions you have, due to paucity of time, we were unable to kind of take any further questions. But anything you have, please feel free to write to us. We'll get back to you. And coming to the application, so the admissions round 3 is on right now, and the deadline for it is 20th of May. You can, so we're just left with 2 days. I think you should apply soon, whoever. So they're filling fast. So I think all the best. That's it. That's it from our end. Thank you so much. Finally, so thank you so much, Professor, and thank you so much for
Thank you all
attendees.
for listening to this, and thank you for your questions. And I hope that this was useful to all of you. Thank you.